I was going through your LinkedIn and I saw your nerdy numbers episodes. They're quite insightful. What inspired you to start them?
Just trying to figure out a way to communicate with investors on a level that you know uh, that geeks out on data the way we do, and just uh, just put our spin on things, just trying to get some attention.
They're quite valuable to your clients.
Some of them seem to like it. We're always trying to grow the list.
Okay, so how long have you been in real estate for?
I've been in real estate since the year 2000.
Okay, and what led you to start Harvard Grace?
Well, I actually started Carver Grace as a consulting firm where we did fractional CFO engagements with various clients over the years. I used to do real estate on the side, just personally, and built up a fairly large portfolio of individual rental units. And I don't like residential, so we pivoted from there. Had a few hiccups during the great financial crisis, and pivoted from there. And in 2018, decided to go to commercial real estate. I just like real estate. It's solid. It's uh, you can touch it. It's real, if you would. And I call it the original subscription business. And because you put the tenants in there and they pay you every month, and usually when you take care of your property and keep it all working nice, and your tenants will stay with you.
Okay, so if I was looking to buy or rent in Nashville this year, what would you advise me not to do?
Hmm. Well, depending upon your needs, I would try to stay out of uh, the Nashville core. You can get much better deals out in the surrounding areas. It depends on whether or not your needs are warehouse or just pure office, or if you need a storefront for customers to come and see you. So that's where your original analysis has to go. But based upon that, then there are various areas you can go to get the best deal you can do.
Would you say that your listings are mainly a percentage of warehouses or offices?
Most of our holdings are office.
Okay, so can you just share a bit about your role and how that fits into the bigger picture at Harvard Grace?
Yeah, well, I am the founder and the CEO. So I started the company and basically crafted the vision along with my board. And we pursue what we call boring properties. We identify stabilized cash flowing assets. We like to buy them at a good price, and structure them so that they will throw off tax advantaged cash flow. So you'll get regular recurring cash flow, and then you'll get some tax benefits that'll help you reduce your taxes on that over time. That's kind of what we do. There's nothing exciting about them. We don't do development. We're just here to provide recurring cash flow.
That's interesting. What does that look like in practice?
Uh, so recurring cash flow, basically we compete with a bank's certificate of deposit. And if we compare what we're doing, certainly we have a higher degree of risk associated with us compared to most banks. Some banks do fail sometimes, but so you got to be mindful of that. But we also are paying 3 or 4 or 5 times what you can currently get on a certificate of deposit. Plus, with the tax benefits, the tax impact of the income that we're providing investors will be far lower than just getting straight interest income and paying your tax on that. So generally, that means in the first year of a property that we are offering, an investor can expect about 6% cash on cash return. Most of that will not be taxable because of bonus depreciation rules. So that'll be completely sheltered. We expect that to jump up about 3% a year. So first year will be 6, the second year will be 9% cash on cash, and then from here it'll go in. It should stabilize around the 13-14% cash on cash return mark for for years 3 through 5. And usually in that range, depending on interest rates, we will do a cash out refi and then send additional cash back to the investors, and so then they've got a chunk of money back, which they can keep or do another deal with, or whatever they want, and then we'll try to pull that back to starting over at that 6% cash on cash again. And that's what that looks like. It's just good old. We call them boring because not a lot to report on. Hopefully, sometimes things do get hit by weather events, and you got to deal with that. Sometimes you do have large tenants move out, so we try to eliminate all risks except for vacancy risk. You can't make them stay.
It's like a big part just keeping your thumb on the pulse and keeping on top of everything in the market
Sure,
and what's
yeah.
going on.
Yeah, I'm managing the whole. We do property management, we do asset management, and I oversee it all.
What does a typical day look like for you, if there is one?
I don't know if there is a typical day. Get started, just basically seeing what kind of problems there are to solve. Hopefully, my day has several investor calls where I can talk with them. Then I check in with my team, either our finance team or the property management team or the marketing team, and just to oversee and provide directions. And then usually once a week, I try to give my board an update as to everything that's going on. And so I don't know that there is a typical day. They all just get filled up with various things to do.
It sounds like you're constantly keeping up those relationships that you've got with your investors and your staff.
I like talking to my investors a lot.
Yeah, I suppose that they need to like the reassurance of their investment, and coming through yourself being the CEO of Harvard Grace, that is quite important.
Yeah, they call me and I call them, and most of us talk a lot. Some of them don't want to talk very much, and that's okay. We send out monthly reports, so they get information that way. Then others like to get their reports verbally from me, and that's fine too.
Okay, so when you started, how did you get your first clients?
Well, I am a CPA. I had a CPA practice for more than 20 years. So I actually started with investors who had been my clients, and then some of them bring in friends, and then I go to events to meet people, and then pick up investors from there, and now we run a very active marketing operation to try to attract new people to talk to us, and we get to know them. So anything we can think of that will start to build a relationship. We're certainly not a high pressure sales kind of an organization that says, well, you better get on this one because it's about to be gone. There's always another deal. And we're never going to be the kind of people that try to pressure somebody to invest with us. But we do want to build relationships, because once you do start investing with us, we hope you invest with us several times across various deals.
I was going to lead you to my next question about, repeat customers, as well as the connections that you're building with them. How likely are they wanting to keep coming back and trust you with their investment?
I'd say about 20% of the people we've invested with have invested in every deal we've done. Might not, it might be 15%. I don't know the answer to that. We have multiple people who've invested in multiple deals with us, and then we've got probably half of them that's only done one deal, and I honestly couldn't tell you why they haven't done another one. Those tend to be the smaller people, and maybe that's what they did with that cash, and now they found something else to do with their cash. So, but yeah, it's rewarding when people continue to come back.
I can imagine it gives your company such a good reputation, that you can rely on these case studies that you've got from these past clients that have been in, maybe half a dozen or a dozen deals that you've done.
Yeah.
So, what shifts are you seeing in the industry right now?
Well, it is interesting. The last 5 years, you start out with COVID and really low interest rates, and then we saw interest rates spike back up, and now they're moderating. I for one, kind of like where interest rates are right now. It's always easier when they're a little lower. Um, but while interest rates were rising, sellers had not readjusted their expectations on what their properties were worth. Because as long as debt is a major part of the equation, interest rates are will dictate the value of asset prices. Um, and so now we see sellers moderating. Sometimes they've been holding a lot longer than they wanted. Cap rates are in the sevens and eights, maybe even a little higher, which is a great place. If you can buy a property at a cap rate of 8 and you can finance it at 6.5, you've got positive leverage going on, and it makes for a very nice cash flow situation. Uh, and I think we're going to be there for the next 24 months. And then I think cap rates will start to come down. Sellers will start demanding more. But I think we're coming into a time where we're going to have the opportunity to get some really great stabilized assets at really great generational type prices that we might be able to flip in 4 to 5 years or hold, depending on what you want. And yeah, I think there's just a really great opportunity, a real buying window coming.
Okay, so considering all of that, how would you say that's impacted your business and growth strategy?
Well, we have launched a fund. We've everything we've done to date is been a single asset deal. We go find a deal that we like. We negotiate the purchase, do the contract, and then we run around and find the capital to help us buy it. And so we've done that 10 times. And now we're pivoting. We've actually launched a $20 million fund so that we can move faster because there are so many more assets in our buy box available. And so we're out we're out raising capital for that fund now. And a part of that, we're also staffing up. I'm hiring investor relations people. I'm hiring analysts and underwriters, and beefing up our marketing team. So our response to this opportunity that we see is building up our capabilities to not only with a bigger and capable team, but also be able to move faster.
Okay, so over time, how has, your approach changed as a result of these experiences?
Well, when we first started doing this, we were kind of slow and deliberate, and which I kind of like slow and deliberate. Uh, you know, if you make the mistake when you're buying a long-term asset, you live with it for a very long time. So, and we're not going to be careless going forward, but we have developed systems and processes that we can now work going faster. The other part of that is we just didn't see a whole lot of opportunities in years before, um, because of sellers' expectations and because of higher interest rates and things of that nature. Um, so, so we've changed, but our response to the market is we think this is going to be a great market, and we're spending our own capital to build up the team to address it.
I suppose you have to move with the market. That dictates business at the end of the day,
We
doesn't it?
could continue to go do um, 1 or 2 deals a year. We could absolutely do that. Um, but we think there's a window where we're going to be able to get some great assets at really great prices, and then those cap rates will come down in future years and asset prices will go up, and so we'll be able to exit some. So we won't just make money on the cash flow, we'll make money on the capital side as well, on the
So
buying side.
gearing up to sort of streamline your processes to get them deals over the line quicker or
Yes.
etc. That's the main goal at the minute.
Right.
Okay, so what would you say is working well for you right now? And in contrast, what's been frustrating for your business?
Well, marketing is always frustrating. I'm a CPA, and I try to cram marketing into into a system and processes, and I take a lot of courses, and I read a lot of books, and I listen to everybody, and we try to do everything these marketers tell us to do, and it doesn't really work very well. And so um, we've addressed that by making some changes on the marketing team, and we've finally hired a fractional CMO who hopefully has a little bit of magic sauce, and will be able to see things a little differently that make our all of the content and all of our effort have a little bit more impact. Um, so that's the frustrating part. What's really working well is in the last few years, 2.5 years, we've really seen our investment thesis sort of be borne out. Like I said, we like to buy boring assets. We buy them stabilized. We buy them cash flowing, and without a whole lot of there's not a whole lot that has to go right for our plan to work. And what we've seen with those skyrocketing interest rates, a lot of the development deals have either gone back to the bank, or the sponsors had to make capital calls, or they've suspended distributions and so forth and so on. And we've had to do none of that. We don't go out and project 50 or 60% returns on our deals. That's not going to happen in a stabilized property. What you will see is, and real estate's a very cyclical market, and we're trying to drive right down the middle of it, and provide something that's stable and that you can rely on, and we've achieved that. That's not to say everything has gone swimmingly. We can't control vacancy risk, as I already said. So we've had some tenants who've reacted to hard times, and they've closed up shop and had to leave. But we've been able to respond to that and been able to fill those spaces back up. So our investment thesis is working correctly, and I'm not throwing any stones at anybody else. The developers they're the ones who take the big risks, and then they make the big money when it works. But sometimes those risks go sideways. So, and I don't think anybody would have ever underwritten a scenario where interest rates would have gone up 5.5 points in 18 months. I mean, that was just really stupid management of the U.S. economy by the Federal Reserve. They should have started long before, and then they waited too late, and then they moved too fast, and it hurt a lot of people. So anyway, so I will just say maybe it's accidental brilliance, but our plan has worked. So
You spoke about improving the marketing side of the business. Why is that a specific challenge right now?
well, because we've come through these harder times where the skyrocketing interest rates made it hard to do a deal, even our kind of deals. But now with the moderating of interest rates, I mean, we were at the peak where we bought one property where our mortgage rate was 8.25%, and the last deal we closed, and I did 2 refinances last year. We got 6.25. That's a vastly different interest rates, and at 6%, sellers can be happy with the price that they're getting, and buyers can be satisfied. Would it be better at 5? Well, of course, but frankly, if you can't make a deal work at 6.25%, then you're paying too much. I mean, that's just a very historically moderate interest rate, and it is improving, and as interest rates have come down. The problem we got right now is that the 10-year Treasury bond keeps going up and up and up, and that's what most mortgage rates are tied to. And it's been fairly low, but I don't know if it's government shutdown fears or whatever it is. Just the 10-year keeps ticking up, and that's what benchmarks most of the interest rates that we follow and track. But just the improving economy, trying to address your question, is better for everybody involved. So,
Okay, so which metrics are you most focused on improving now?
um, always interest rates. Um, we love jobs, but frankly, it makes sense. We don't do any housing anymore, but I track the housing market very closely, because as housing goes, so goes commercial real estate. Because commercial develop follows rooftops, as they say. And so, always concerned about housing, and there's a problem in housing. There's the affordability crisis. We've got a 15-year backlog, essentially, of demand for housing in all forms, multifamily and single family. But nobody can really get financing to move forward. So, President Trump is trying to address it by trying to get the big corporate types to not buy up all the houses. With their build to rent plans. And he's trying to do things with like the 50-year mortgage, all kinds of different proposals. He's trying to attack it. But really what he was trying to get is the interest rates to come down. And we're seeing some improvement there. We're seeing some improvement, but not massive improvement. Housing is even more cyclical than the overall real estate market. So we know it will get better just because it always does. So I follow housing a lot. I follow labor trends a lot. We have a very healthy labor market. And we follow producer price indexes and consumer. We watch inflation, and energy prices. So those, just really all the usual big name type economic statistics. Just trying to watch what's going on. Energy costs are huge. It's the major factor in inflation, and energy costs are way down here in the last 12 months. Hey, lo and behold, look at inflation, it's way down too. It's not the only factor, but it's a major factor.
So you speak about interest rates and wanting them to fall a little bit further. If they don't, what do you think will happen, if that's left unaddressed?
Well, we were buying when the interest rates were 8.5, and we can buy now. It's harder when they're higher. But the way we underwrite, I don't really care what the interest rate is, because I'm going to back into my price that I'm willing to pay for an asset based on what my cost of capital is going to be, and ensure that I can pay my investors a minimum of 6% cash on cash. So the math does it. So it doesn't matter to me. What ultimately only matters is what price I pay for the asset. But that's where it gets harder, because the price that I can pay at 8.5 is not usually the price that a seller wants to sell at. Sometimes it works. Like we did deals when they were at that level. It's just easier to do deals now. So we will continue to underwrite and find deals that we can do, at any interest rate.
Okay. So where do you want to be, in terms of the business from 6 to 12 months from now?
So as we sit here today, where I want to be, really is I want my fund fully invested, and I want to be spending almost all of my time vetting deals, underwriting deals, and adding to assets under management. So right now, as we said, we've got about 48 million of assets under management, and where I would want to be a year from now, I'd want to have almost all of that fund deployed. So if we raise $20 million in equity, that means that we'll probably spend about $50 million in assets, maybe a little bit more, and and so and that'll probably take us 18 months to do. So 6 months from now, I want my fund fully funded, and so that our entire focus is on asset acquisition.
Okay. So if you had a magic wand to just fix one thing in your business that you'd say is holding you back or slowing you down, what would that one specific thing be?
Marketing, the acquisition of new investors, getting people joining our lists, people booking calls with us to talk about how we do business, um, and just to expand the reach of our firm amongst accredited investors.
Okay. And what immediate steps do you think are necessary to overcome that challenge?
Well, I think I've taken all the steps that I can take right now. We've made several marketing team changes, and hopefully those are the right changes. By adding the fractional CMO, I believe that gives us some expertise on our team to hopefully make all of these procedures, all of these tasks that we've been doing, hopefully it makes them more effective.
Okay. Well, look, that was my last question. I really appreciate you being so open about the business.